Hello. Welcome to our next chapter, that is portfolio management. Now, a lot of the students do not like this chapter. I myself, when I was a student, I didn't like this chapter, and that is why we will be studying this chapter because this chapter comes for about an average of 20 marks every attempt. So it is a very important chapter. Let's get right into it. Okay. So when we say about portfolio management, sir, what exactly is this chapter about? First, we will be studying about what exactly is a portfolio, what are your types of risk, how do you calculate standard deviation. A portfolio is nothing but a combination of stocks. So you can calculate your standard deviation for one stock individually. But when there are two stocks in a portfolio, it is also possible that they might be offsetting each other's risk. Correct? Because maybe it is possible that both of them move in the opposite direction when the market moves. So therefore, portfolio management becomes an important chapter to analyze what happens to your portfolio when there are more than one stock in your portfolio. Perfect. So before we start, let's first understand what is your systematic risk and what do you mean by unsystematic risk. So across all these chapters, across your CPT inter final, you would have learned about the term beta. Okay, so we have two types of risk. That is, first is systematic risk and second is your unsystematic risk. Systematic risk is what we call as beta. So the risks that are external to the company, that is something that the company cannot control. For example, your interest rate risk, your market risk, purchasing power risk, all of these are your risks external to the company, that is your systematic risk. It is uncontrollable in nature, it cannot be controlled, and it is represented by beta. So whenever during the questions, when we have called anything as beta, we are referring to a systematic risk, that is the risk that is exterior to the company. Next is your unsystematic risk. This risk is also called as idiosyncratic risk. It is called as idiosyncratic risk because it is your examples such as your business risk and your financial risk. So risk, those are inherent in your business or which is due to the capital structure of your business, your financial structure, that is your unsystematic risk. This can be controlled and avoided. Okay, so let's revise quickly. We studied two types of risk. First is your systematic risk and second is your unsystematic risk. Systematic risk is nothing but your beta. Unsystematic risk is also called idiosyncratic risk. It is also called as idiosyncratic risk and which can be controlled. So your total risk, whenever we say total risk, you know by now that we say risk as standard deviation. So your total standard deviation is your A plus B, that is your systematic risk plus your unsystematic risk. Now let's see how do you calculate standard deviation in two cases. First, when probabilities are given, and second is when historical data is given. So whenever you are calculating standard deviation, either they will give you data of the past to calculate standard deviation of the future. So therefore that is your historical data. And second is they might give you probability, that what are the probabilities of different prices or what are the probabilities of different events. So that is your probability method. So let's start with the probability method first. That is, everything in this that is given in the colored is part of your question and everything that is in black is part of your answer. Okay. So they've given you that there's a stock X which gives a return of 20%, 30%, 40%, 50% or 60% with a probability of 20%, 20%, 40%, 10% and 10%. So they have given you return percentages and they have given you probabilities of each return percentage. Now what do you do? Every time, remember, we always, whenever you are calculating standard deviation, you have to do x minus x bar, where x bar is either your average or your mean value or your expected value. So therefore, how do you calculate your average? You do x into px and you sum all of them. Okay, so I have also given the formula of how to calculate the mean in case of probabilities. So let's do it. So we have 0.2 into 0.2 equals to m plus 0.3 into 0.2 equal m plus 0.4 into 0.4 equals to m plus 0.5 into 0.1 m plus 0.6 into 0.1 m plus, and you get your x bar as 0.37. Okay, so now you know your x bar is 0.37, 0.2 minus 0.37 gives you a negative of 0.17. So you put in all of these values here after you've calculated your x bar and you subtracted it. Now what you do the next step, you multiply it by itself, that is you square it. So you x minus x bar whole square. So this is nothing but 17 square is 289 and 2 decimals, so now it becomes 4 decimals, so 0.0289. Therefore, you do this for all such row items and you multiply it. So now you have x minus x bar whole square, but if you realize this is all for probability, so you multiply it with your probability. So you do 0.0289 into 0.2 and you will get these probabilities. Once you get all of these probabilities and you add this, you will get your variance. Remember, this is not your standard deviation in your exam. Always remember, this is your variance. This has to be square rooted. So 0.0141 is your variance. When you square root this, you get 0.1187. Your standard deviation is calculated. That is, your total risk has been calculated as 0.1187. Okay, so this is nothing but your basically 11%. Great. Next, okay, how do you calculate if your historical data is given? And if historical data is given, they have given you data for the last 5 years. Perfect. They have given you data for last 5 years and they have given you X, that is your return percentage, as 9.5, 7, 11, -6 and 2.50. What do you do? Again, you do the same part. You calculate the average. So you calculate the average of this simple average. This is, you just add all of this and divide it by 5. Then you do x minus x bar. You calculate x minus x bar for all of this. Then you x minus x bar whole square. Once you squared it and you come up with the sum. So this is 187.30. Sir, is this my variance? Answer is no. This is not your variance. If you remember, while we were doing it via probability method, we multiplied by probability. Over here, we will divide it by the total number of years. So 187.30, excuse me, divided by 5 and you get 37.46. This 37.46 is your variance. Again, same thing. We will square root it and we will get 6.12 percentage. So that is your standard deviation of 6.12% in this method. I hope this is clear. Whenever you are doing via probability method, first you find out the expected value by multiplying it by probability. You do x minus x bar, then you do x minus x bar whole square, then you do x minus x bar whole square into probability and you sum this. When you sum this, you get the variance. When you root it, you get the standard deviation. This was your probability method. Coming to next, that is your historical method. In historical method, you find out the average, simple average. Then you do x minus x bar, then you do x minus x bar whole square. You find out the sum and you divide it by the total number of years. Now what you will get is your variance. You square root this and you will get your standard deviation. Okay, we are clear with how to calculate standard deviation in both cases. Perfect. Sir, what do you mean? What do you mean when we say that there's a standard deviation of 3% or etc.? So what we are saying is, when a security has a return of, say for example, 11%. A security has a return of 11%, that is your X bar, that is your average, and your standard deviation is 3%. If there is a standard deviation of 3%, but your mean is 11%, that means that the range can be expected from 8% to 14%. That is 11 plus 3% or 11 minus 3%. So 8 to 14%. Perfect. That's clear. Yes. Next is your measurement of systematic risk. That is, when we say systematic risk, that is your beta. So there are some formulas to calculate beta. We will be seeing these. So we will be doing the correlation method, that is to calculate beta. It is nothing but your correlation coefficient. So what is correlation coefficient? I'll tell you. It is your correlation coefficient between your security and your market. Correlation coefficient into standard deviation of X, that is security, upon standard deviation of market. Okay. Sir, what do we mean by correlation coefficient? Correlation coefficient shows the strength and direction of movement between your security and the market. So what does they show? They show the strength as to how strongly, and the direction, whether they move in the same direction or whether they move in the opposite direction. When we say they, we mean your security and the market. And when we do standard deviation by X upon standard deviation by M, we get the relative volatility of X compared to your market. Okay, so first formula, what did we learn? We learned your beta. Your beta is equal to correlation coefficient of Xm into standard deviation of X upon standard deviation of M. Okay, now sir, how do you calculate correlation coefficient of Xm if they have not given it in the question? Perfect. So correlation of coefficient is calculated by this formula, that is covariance. Covariance Xm upon standard deviation of X into standard deviation of M. Sir, now what is covariance? We understood what is correlation coefficient. What is covariance? So covariance tells us the joint movement. That is, it only tells us direction. It does not show us the strength. It only tells the direction. Dividing it by market variance tells the movement per unit change. So this is just another formula beta. But otherwise, covariance just tells you movement, right? So covariance has told you movement. When you divide it by standard deviation of x and standard deviation by m, you get your formula of correlation coefficient. So correlation coefficient is equal to covariance upon standard deviation x upon standard deviation of m. Perfect. Now, sir, how do you calculate covariance? Okay, so I've tried to link all the formulas here itself. So your covariance can be calculated via four formulas. That is your x minus x bar. Okay. When we say, tell me, does this covariance not sound very familiar, very similar to the variance that we calculated above? When we were calculating variance, what did we do? We calculated variance of stock x with stock x itself. Therefore, we did x minus x bar into x minus x bar, that is x minus x bar whole square. Correct? Because in that we were finding out the relation of the stock with itself. Now we are doing covariance, that is stock with market. So therefore, what are we doing? We are doing x minus x bar multiplied by m minus m bar, because now there are two parties in this, right? So therefore, you don't do x minus x bar whole square, you do x minus x bar into m minus m bar. Clear? Easy way to remember. Perfect. So you have x minus x bar into m minus m bar. You multiply this and then you find the sum and you divided this by n. So you will get your covariance. Okay, sir. What is the other method if you want to do it via probability method? If you want to do it via probability method, same. Over there, what did we do? We did x minus x bar whole square into probability. Now what are we doing? We are doing x minus x bar into m minus n bar into probability. Same formula, nothing different. Clear? Both of these are same. And your other two formulas are nothing but just merging of your this formula, correlation coefficient, for example. So your covariance is equal to correlation coefficient of xm into standard deviation of x into standard deviation of m. Okay, perfect. Yes. Okay. So now this is your next formula, and last is your beta of x into beta of market into standard deviation square of market, or we can also call this as variance of market because it is squared. Okay. Perfect. So these are your four formulas for beta and covariance. These four formulas were part of your covariance. Next is finding formula via the regression method. So in the regression method, they've given us a general formula, that is x is equal to a plus beta m. Now x is equal to return on stock. Your a, that is alpha, is the stock return independent of market. As per the regression model, they are saying that boss, not everything is dependent on the market. Some return the stock is earning by itself, so that they have represented by alpha. So therefore, your beta market, whatever they get, this is your return due to market, but this alpha is independent of the market. Okay. So how do you calculate beta in this way? In this method, you calculate beta by xm, then you sum it, multiplied by n minus sigma x sigma m upon your n into sigma m square minus sigma m whole square. Sir, very complicated formula, didn't understand shit. Don't worry, we have a question on this. The best part about this note is whenever you have a concept, we also have an illustration on it. Perfect. Everything part in orange is part of your question, everything part in black is part of your answer. So we have 5 periods, period 1, 2, 3, 4, 5. You have your market return, that is 10%, 8%, 12%, 6%, and 9%. You have your stock return, that is 14, 13, 15, 10, and 12. Then you have your market return squared, and you have your XM. So these first three columns were given in the question. The next two columns, we've done it as part of the answer. Why have we done it? Because if you see, we need this M square and we need this XM. So therefore, we've included this in the table itself. Perfect. M square is nothing but column M whole squared, and XM is nothing but M into X. And we've calculated the sum of these. Perfect. So now we will calculate what is your beta. Now to calculate beta, you get n. How many n? We have 5 periods, correct? So we did 5. Next, your xm. What is xm? Xm is 592. So we've done 592. Next, what is in the formula? Sigma x. What is sigma x? 64. Nothing we are doing. We're just putting values in the formula. You just have to learn the formula and put it. Okay. So your sigma x is 64. So we put 64. What is your sigma m? Your sigma m is 45. So we put 45 here. Same thing below. N, that is your 5. So we put 5. Sigma m square. What is your m square? Sigma m square is 425. So we put 425 minus it says sigma m whole square. So we have sigma m whole square 45 whole square. So we got a calculation that beta is equal to 0.8. When we say beta is equal to 0.8, what does this mean? That when my market moves by 1%, my stock only moves by 0.8% because of the market. Perfect. Now we put the same thing in the formula. So now what is your x? X is equal to your 64 divided by 5. That is your sum. That is we're doing nothing but we're taking average. 64 divided by 5, we get 12.8. Alpha, we don't know yet. So alpha remains as it is. What was next? We have beta into m. Beta we calculated 0.8 and m is nothing but 45 divided by 5. So nothing. We are just doing average. So we get alpha is equal to 5.6. Therefore, what does this mean? That the stock return will be 5.6%. Even when the market earns 0%, the stock will give you a return of 5.6% because this alpha is independent of the market. And when the market return is 10%, the stock return will be 13.6%. Sir, how do you calculate this? We do 10 into 0.8 plus 5.6 and you get your 13.6. Clear? Easy so far? Perfect. Let's get on to the little complicated part now. That is your starting with portfolio analysis. First, what did we do? We only understood how do you calculate standard deviation. Then we understood how do you calculate beta. Then we did this regression model. Now we are getting into portfolio analysis. So whenever you want to calculate portfolio, you will do return and you will find standard deviation. Perfect. So what we are doing right now, we are understanding how do you calculate this when there are two securities involved. So in case of two securities, how do you calculate the return? The return is easy. You do weighted average basically. You do weight of security X into return of security X plus weight of security Y into return of security Y. Now, how do you calculate standard deviation? Standard deviation, if you see, it is a very simple formula. It is very similar to the formula A square plus B square plus 2AB. But this part is extra in 2AB. Perfect. Why is it extra? Because they are saying that boss, when there are two securities in a portfolio, both of these securities can also offset each other's risk. So therefore, it is important to understand their correlation. Therefore, this is additional in the formula. Okay. So let's see, you have your weight of x into standard deviation of x whole squared. That is your A. Then you have weight of y into standard deviation of y whole squared. That is your B. Next, what do you have? You have 2 weight x, weight y into standard deviation of x, standard deviation of y. So sorry, this was your, till here it is your 2AB. Correct? So you have 2 weight x, standard deviation x, weight y, standard deviation y. Then what do you multiply it with? You multiply it with correlation of xy. This is your only additional part. Do not forget. I was going to say do not remember to put this. Do not forget to put this in the formula. Your answer will change. So you find out the correlation and you put this into root. You get your standard deviation. Now tell me. Now tell me, sir, what would have happened? What would have happened if my correlation is 1 or minus 1? If the correlation between the securities is 1 or minus 1, what happens in such a case? You see, if your correlation, basically this part, if correlation is your 1, does this not become the simple formula a plus b whole square? If this becomes 1, your entire this becomes a plus b whole square. A plus b whole square, if we do a plus b whole square and you put it into root, doesn't the square and the root cut off? So you are left with a plus b. So you will only be left with weight of x, standard deviation of x plus weight of y, standard deviation of y, simple formula. Like your formula of the return, your standard deviation will also become the same. Okay, now sir, what happens if it was minus 1? Tell me, if it becomes -1, does it not become the formula of a square plus b square minus 2ab, right? Because your correlation xy becomes minus, so it becomes a square plus b square minus 2ab. Is that not the same as a minus b whole square? We put this under root, square root, and everything get cancelled. What are you left with? A minus b. Okay, perfect. Yes. Let's do a quick example. So for example, stock X return is 12%, stock Y return is 18%, standard deviation of X is 10%, standard deviation of Y is 16%. Correlation XY is 0.5. Tell me, can we use the formula A square plus A plus B whole square? Answer is no, because it's not 1. So correlation XY 0.5, weight of X is 0.6, weight of Y is 0.5. Perfect. They've given us all the information that we require. Tell me, is that true or not? So you get your portfolio return. Portfolio return is what? Portfolio return is your weight of X into return of X plus weight of Y into your return of Y. So you will get your 14.4%. Portfolio risk is similar. So you have your 0.6. What is 0.6? Weight of X. So you have your weight of X whole square into standard deviation of X whole square. Standard deviation of X whole square. So this is your standard deviation. Then you again have your weight. You have your standard deviation. You have 2 into weight. Then 0.4 is the other weight. This is your one standard deviation. This is your second standard deviation. And this 0.5 is your correlation XY. Whenever you calculate this, you will get your 10.74%. That is your standard deviation. Okay. Now, sir, what do we do in case of 3 securities? So for whoever's purchased these notes, you can write here. This is an example in case of 3 securities. In case there are 3 securities in your portfolio, nothing you have to do. Okay, so you have your 3 securities, that is your X, that is your security Y, and that is your security Z. Their weights have been given, that is 0.25, 0.35, and 0.40. Other information, they correlation XY has been given, correlation XZ has been given, correlation YZ has been given, that is correlation of all 3 with each other has been given. You've been given standard deviation X, Y, and Z. So standard deviation of all 3 and weight is given in the question. You have to calculate what would be your standard deviation. In this case, what do you do? What do you do? I have this Instagram reel of this girl coming up on my, dear, if we wanna do, then what do you do? Okay, perfect. So now, how do you do this? You do 0.25 into 0.25. What is 0.25? First you do weight from here, then you do weight from here. So you get 0.25, 0.25. Then you do correlation of both of the securities. Tell me, what is the correlation of X with X? It is nothing but 1. Okay. Then what do? You do standard deviation of X, standard deviation of this security, and standard deviation of this security. So you get 16 and 16. Got it? Let's try another one. Okay. So we are doing standard deviation with X and we are doing this with Y. So we are doing this one. Okay. Now what is the weight of X? Weight of X is 0.25. So we have 0.25. What is the weight of Y? Weight of Y 0.35. So we have 0.35 here. Then what do we need? We need standard deviation of Y. So standard deviation of Y is 0.7. Your correlation of XY is 0.7. Perfect. Then we have your standard deviation of X, that is 16. And then you have standard deviation of, where did my standard deviation of Y go? Yes, standard deviation of Y, that is 7. So like this, you fill the entire table and you have this. So therefore, first 2 are weights, middle part is correlation, and then next are the standard deviations of both the securities. Once you add all of this, you will get your variance of the portfolio. If you put it into root, you will get your standard deviation. Tell me, is that clear? So this is how you to calculate it for 3 securities. Perfect. Next is your capital market line. What do we mean by capital market line? So capital market line says that if you take a certain amount of total risk, this is the return that you should expect if your portfolio is efficient. They are saying that, boss, if you're taking a certain amount of risk, you know that your reward, that your return is your expectation of the risk, that is the risk that you are taking. So therefore, they are saying that if you are taking some X amount of risk, this is the ideal amount of return that you should be getting. Okay, so let's understand this. What are they saying? So you have your capital market line. This is your axis. Okay, this is your X and Y axis. This is your Y axis. This is your X axis. Yes. Okay. So as per the capital frontier line, they say that this is how the line should go. Basically, if this is your return and this is x-axis is your risk. Sir, why does it not start from zero? Because of the existence of risk-free security. So this gap that is there is nothing but your RF. So at zero risk, you get some percentage of return, and then for every risk that you take, you should get some return. If say your portfolio lies in this region, that means your portfolio is not efficient. Why? Because you are taking this amount of risk, right? But you are getting this amount of return, while as per this line, if you would have taken this amount of risk, you would have been getting this much return. So therefore, there is a shortfall in your portfolio of return. Therefore, your portfolio is not efficiently managed. This is your capital market line. So the line that we drew, that is your capital market line. Let's see what the formula is. Your expected return is equal to RF. Remember, we started it from that point. So therefore, RF2 you are going to get irrespective, risk-free. Then what do? You do RM minus RF upon your standard deviation. This is called your Sharpe ratio. So Sharpe ratio says that your RM, that is your return of market, minus your risk-free rate divided by your standard deviation, that is your, when we do RM minus RF, what are we doing? We are doing excess return. Tell me, is this not excess return, or can we say this as risk premium? So we are doing risk premium divided by your standard deviation. That is your return per unit of risk. Understood? So your expected return should be your RF plus your whatever risk you are taking per expected unit of whatever extra return you should be getting per unit of risk, into you multiply this by your standard deviation of the portfolio. So this is the return that you should ideally be getting. So RF is your risk-free, RM is your market, standard deviation of portfolio, and M is your standard deviation of market. Tell me if this is clear or not. Tell me. Correct? So over here, what did we do? We found what should be the return that we should be getting per unit of risk that we are taking. Okay, so this is the per unit, and then when we multiply it by the risk that we are actually taking, we get how much return we should be getting. Perfect. Next is your single index model, that is your Sharpe index model. So they say, as per the Sharpe index model, it says that the return of a stock can be divided into two components. What do we mean? That is, first that a return due to the market, and second is independent of the market. Right? So they say some return you get due to the market, other because of market sentiment, and other type of return that you get is independent of the market. And just one point I've highlighted here because there's a question in your institute module. So what do we mean by coefficient of determination? Coefficient of determination means percentage of variance of a stock return explained by variation due to market. So whenever we say coefficient of determination, we mean the return due to 1, that is due to the market. Okay, this was just a term. So now let's understand what are the formula. Let me change the pen color so it's easier to read. Yes. So now your formula talks that your return of X is equal to your stock's average return unrelated to the market. Unrelated to the market, this is your 2 over here, independent of market. And then there is your beta X into your RM, that is your stocks beta multiplied by your return of market plus any error, that is return on account of unsystematic risk, that is your EX. All of this becomes part of your market, that is comes under 1. Okay, let's learn the formula in this. Over here I am not able to explain any logic. Next is, sir, how do you calculate the standard deviation or how do you calculate the variance? So see, your variance is nothing but your systematic risk plus your unsystematic risk. Correct? That is your total risk. So therefore, it is beta square into standard deviation of market whole square. That is nothing but your variance. So your beta square into variance plus your variance due to unsystematic risk. And last part is coming to your covariance. Covariance xy is equal to beta x beta m into your standard deviation whole square of m, or we can also call this as variance. So beta of x beta of y into your variance. Okay, so let's try solve a question on this and we'll understand whether how much we've understood or not. So they've given us two stock, that is stock X and Y. They've given us their weight 0.6 and 0.4. They've given us beta 1.2 and 0.8, that is stock X is more reactive, stock Y is less reactive. Then they've given you error also, that is E, that is your unsystematic risk return. So 0.18 and 0.12. Till here is part of your question, and they've given the standard deviation of market as 0.15. They've asked you to calculate what percentage of the risk is unsystematic risk and what percentage is the systematic risk. So you can type here, you can write here what is the percentage of systematic and unsystematic risk. This will be the question. So let's understand how do you calculate this. So first you will have to find your weight into theta, and second is your weight square into your error term. We'll see how, why we are calculating what we are calculating. So that is your beta square into your market variance. Your beta square into x. Where is this? Where is this? What are we calculating? We are calculating this part. Understood. So first because we have to calculate it, because we have to calculate the risk as to what portion is systematic risk, what is unsystematic risk. So we have to calculate them individually. And because we have two securities in this, so therefore we will be using weights. So what do? We multiplied weight into beta and we got 1.04. That is your basically your weighted beta. Your weighted beta is 1.04. So you square this, and your market variance they've given you is 0.15. They've given you standard deviation as 0.15. So to get your variance, you will do 0.15 whole square, and you get this as 0.02434. This is your systematic risk. This first part is your systematic risk. Next, coming to your unsystematic risk, that is your variance. So to calculate variance, you do nothing. It is a very simple weight into your standard standard deviation. So you multiply this whole square, you get 0.01396, and this is your unsystematic risk. Okay, and you get a total that is your 0.03830. 0.380 is your total risk, but if you want to calculate what percentage is your systematic risk, so we will do 0.02434 divided by 0.03830, and you get that 63.5% is your systematic risk, while 36.5% is your unsystematic risk. Tell me, is it clear or not? Any doubts? Let's move ahead. So therefore, they're saying that the unsystematic risk of 36.5% can be reduced by increasing the number of stocks. This is how you can manage your unsystematic risk. Nobody can do anything about systematic risk. Systematic risk will always exist, like we studied in the start of the chapter. Yes. How many pages do we have left after this? Let's see. We have portfolio rebalancing. Yes, mostly that should be the last one. Perfect. So we have two more pages. If you want, you can pause the video, take a little break, and we can start with the next part. Yeah, I'll also get some water. Perfect. So we have your capital asset pricing model, that is your CAPM method. We've learned this a lot of times. What do we mean by CAPM model? Your capital asset pricing model is basically the minimum expected return needed for investors to purchase and hold the security. What is the minimum return that is your RE, that is your return expected, is equal to RF plus beta into RM minus RF. Your RM minus RF is nothing but your risk premium. You multiply this with beta and add RF is what you get your expected return. In case multiple risk-free rates are given, there's a question in your institute module, therefore we've added this. If multiple risk-free rates are given, for example, the lowest and highest bidders of the same government security, what will you do? You will do average of both and you will move forward with your life. It is also used to make decisions in case of buy, sell or hold by comparing required return with expected return. Okay, perfect. Next is your arbitrage pricing theory. So the arbitrage pricing theory says that uses risky assets, expected return and risk premium of macroeconomic factors. So it is nothing, it is very similar to the above formula. Just over here, what did we do? We multiplied beta with only one risk premium, that is your RM minus RF. In this case, they're like, sir, why are we only considering one? We should calculate all other macroeconomic factors. What are the other macroeconomic factors? One of them is market. This market we've already calculated here, that is your RM minus RF. What are your others? For example, growth rate of GDP, inflation. So all of these are risk premium and they have their own betas. So therefore, what do? You have RF of 8%. So you do 8% plus your risk premium into beta. So that is your 4% into 1.3. Then you do 1% into 0.3. And then you do 0.2 into negative 4% and you get as 12.7%. Perfect. So that is your expected return when we consider other macroeconomic factors as well. Yes. Now coming is your portfolio evaluation method. So portfolio evaluation method, we have basically three ratios that you should remember. First is your Sharpe ratio, second is your trainer ratio, and third is your Jensen alpha. Sir, what do we mean by this? Let's understand. First is a Sharpe ratio that says Rx minus Rf divided by standard deviation of X. If you say Rx is your return of security minus risk free. So if you find the difference, what is it? This is your risk premium. Your risk premium divided by your risk taken. So therefore it is risk premium per unit of total risk. Risk premium per unit of total risk. Okay. So remember over here we've divided it by your standard deviation of X. In trainer ratio, what does he say? He says, boss, let's only focus on the systematic risk. So that is your Rx minus Rf. Both of them are the same, but over here you divided it by beta of X. So therefore risk premium per unit of your systematic risk only. Okay. And last is your Jensen alpha. What does Jensen alpha talk about? Jensen alpha tells it is your actual return minus your expected return. If your expected return, say for example, is only 12%, but your actual return is 18%, so Jensen alpha will be 6%. That means you are earning 6% more than what you expected. Therefore, all of these ratios, whether it be Sharpe ratio, whether it be trainer ratio, or whether it be Jensen alpha ratio, higher the better. The higher the ratio, the better it is. Now coming to your most complicated part of this chapter, Institute has only given the formula, they have not given any questions. So I urge you to please focus on this example that we've included, so that because this will not be covered anywhere else. A lot of the faculties also just put in the question and they don't put in any example because it's very complicated, but it is very much possible that Institute can ask this. Institute has done this previously where they've put in just the formula and then they've asked the question in the exam. Okay, so there is a Sharpe's optimal portfolio that talks about that. It says that first securities are ranked as per the excess return per unit of systematic return. Do you realize the irony here? What does it say? It ranks securities by excess return, okay, per unit of systematic risk. Sir, when we studied Sharpe ratio over here, did we not divided it by total risk? Wasn't trainer ratio dividing it by systematic risk? So why are we calling this Sharpe's optimal portfolio when we are using formula of trainer? Okay, so remember in the exam you will get confused that, oh, the examiner has told me to solve this via sharp optimal portfolio, so I should divide it by total risk. No, you have to divide it by the trainer ratio. Okay, so it is the excess return per unit of systematic risk. Remember this, you have to calculate, dividing it by systematic risk. Then you have to find the cutoff value C. Okay, we will solve the question and you will understand. Securities whose adjusted excess return exceed that cutoff are included. Final weights are proportional to each security's excess return above the cutoff scaled by its idiosyncratic risk. Okay, this idiosyncratic risk was your unsystematic risk. Perfect. So in this question, they have given you RF as 5%. They've given you variance of market as 9%, or you can say it as 0.09. The original order that the question was given was in ABCD, but because we merged the question and answer, we've just rearranged it as per our answer. So original order was ABCD, and these three columns were given. That is your return of X, beta of X, and your variance of your idiosyncratic risk. Okay, so what is your first method? They say that first we have to calculate the trainer ratio. So we've calculated the trainer ratio. How have you done that? We have done RX minus RF divided by your beta of 0.8. Let's calculate one and check. That is 0.12 minus 0.05 divided by your 0.8. Does that come to 0.0875? Right? So you got the trainer ratio. Similarly, you calculate trainer ratio for all of these securities. Then there is a little complicated part, that is your Rx minus Rf into beta of X. Okay, and you divided it by the variance. So Rx minus Rf multiplied by beta divided by the variance. So similarly, you will calculate these value, that is 2.8, 3.25, 3 and 3. And then last part that you calculate is your beta square X upon your variance of idiosyncratic risk. So you get 32, 37.5, 36 and 36. Right? Now, what did they say? Rank securities by excess return per unit of systematic risk. Basically, what do we have to do? We have to rank as per the trainer ratio in descending order. That means from highest to lowest. So the highest trainer ratio is with security B, followed by C, then D, A. That is 0.875, 0.0875, 0.0867, 0.0833, and 0.0833. Okay. So we've ranked them therefore as per B, C, D, A. Now what do? We calculate this C that we've been talking about. Okay. So what does that equal to? That is your 0.09. What is your 0.09? 0.09 is your standard deviation. That is your standard deviation of market whole squares. That is your variance. This you multiply by 2.80. Okay, so you do multiply by 2.80, and in the denominator you get 1 plus 0.09 into 32. That is, this is your 32, and your 0.09 is again your market variance. So what do? This is basically your market variance into your this big formula. I will call this as BF, something which you don't have. Next, 1 plus 0.09, that is again your market variance, multiply by this your smaller formula, that is your 32. This is your formula. So you calculate this for, first you calculate with B, then you do cumulative B and C, then you do cumulative B, C, D, then you do cumulative B, C, D and A. Okay, so when you do B and C, your 0.09 remain the same. This 2.8 now also has a best friend 3.25. That is, one is of B and other is of C. Similarly, over here also you have 32 and you have 37.5. So you have 32 and you have 37.5. So like this, you will calculate for security B, then B and C, then BCD and BCDA. So these are the values that you get. That is 6.45, 7.5, 7.76 and 7.896 percentage. Then what did they say? Finding a cutoff value C star. How do you calculate C star? C star will be whichever is highest among all of these. Whichever is highest, that is in our case, it is all four securities B, C, D and A. So 7.896 becomes our cutoff point. Okay. Yes. Now coming to your next part. So therefore, all four securities will be included. So now you have to calculate it. Now you have to calculate ZX, that is your Rx minus Rf minus beta of x into C star upon variance, that is your idiosyncratic risk. So we put on all of these are value, that is 0.15, 0.12, etc. Everything, all of this we just put in this and we get as 13%, 34%, 19%, and 26% as weights. But if you see carefully, all of this adds to only 92.79% and not to 100%. So what do? We normalize it. We normalize it to 100%. So if 92.79 is my 100%, so my 13.12% is how much? So therefore we get our new weights, and this is the weights that your portfolio should be for a optimal portfolio. I know, little complicated, a lot of formulas. If you want, pause the video and just see the formulas once. Okay, so this is a formula that you have to learn, and the above three formulas that were in the table. So by this you have got the weights for an optimal portfolio, right? And coming to the last part of this chapter, that is your portfolio revision and rebalancing. It is a very easy concept, much easier than what we just did. And with this, we will be ending the chapter. So first is your buy and hold policy, that is do nothing policy. No rebalancing is required. You buy and let it be. Second is your constant mix policy. It is a do something policy. It is where investor maintains exposure to a stock at a constant percentage of total portfolio. Say for example, I've decided that my portfolio should have only 50% of stock. I do not want more than that. But the share price keeps increasing and decreasing, so therefore I will have to adjust this. So purchasing and selling a stock as and when prices go down and up respectively. So whenever the price goes down, my equity portion will reduce in the portfolio. So therefore I will be purchasing more, and whenever it goes up, I will be selling the stock. Let's see an example. So originally my share price was 100 rupees and I had a total portfolio of 1 lakh rupees. And if I say that, boss, I want only 50% in shares and the rest 50% should be in bonds. So therefore that is how I will follow. So therefore 50,000 is in shares and 50,000 is in bonds. So before rebalancing, now my price goes to 80. Now my price goes to 80. So now this 50,000 worth of shares are now worth only 40,000. Nothing I did. I just did 50,000 into 0.8. So I got 40,000. But my value of bonds is still 50,000. So now my total portfolio is for 90,000. Tell me, is that right or not? 90,000. What was my promise? My promise was that my portfolio should not have more than 50% of stock. It should have equal to 50% of stock. It should not be more than, it should not be less. So 90,000, 50% is 45,000. That means I need 5,000 more of stocks. If I need 5,000 more of stock, so can I do that? I sell my debentures worth 5,000 and I buy 5,000 worth of shares. Correct. So I got 45,000 worth of shares and I have 45,000 worth of debenture. Equilibrium has been restored. I have 50% of my portfolio in shares. Next is, say for example, if my price goes to 130. If my price goes to 130, now my shares are worth 65,000. Tell me, is that right or not? Is that right? Hmm. Okay, so this situation of 130 is not after the situation of 80. This situation of 130 is, we are saying, after 100. So say for example, after 100, if the price went to 130. Okay, so I had original 50,000 worth of shares. Now 50,000 worth of shares into 1.3 will get me 65,000 shares. So therefore my worth is now 65,000 while my value of bonds is 45,000. So now total is 101 lakh 10,000. Again, I want it to be 50-50. So I will want 55,000. So therefore, I want 55,000 here. That means I will sell shares worth 10,000. So I sold shares worth 10,000 and I will get 45,000 to 55,000. This is your constant mix policy. And coming to your last part, that is your constant portfolio insurance policy. It is a limit set by investor below which he does not wish his assets to fall, which is called the floor value. The investor sets a floor value. Target investment in shares is a multiplier into a cushion, that is your portfolio value minus your floor value. Okay, cushion. Let's see why an example as to what do they mean exactly. Wealth of Mr. A is 1 lakh. Floor value he has set as 75,000 and multiplier is of 2. Okay, this is what is given. At the start, the price is 100 rupees. So your portfolio total worth starts with 1 lakh. And it says that floor value should be 75,000. So if my floor value 75,000, that means my cushion, that is your portfolio value minus my floor value is of 25,000. Correct. So my question is of 25,000 and they've given us a multiplier of 2. That is what I am allowed to put in shares is my cushion into your multiplier. That is I am allowed to put 50,000 into shares. So 50,000 goes into shares, 50,000 goes into bonds. Perfect. Now if the price falls to 80, my value of shares falls from 50,000 to 40,000 while my bonds stay at 50,000. So now my total portfolio is 90,000. My cushion has reduced from 25,000 to 15,000 because 90,000 minus 75,000, that is the floor value. Now 15,000 is my cushion. And how much am I allowed? I am allowed only into 2x, that is 30,000 I should be having. But currently, what do I have? I have 40,000. So to come to 30,000, I will be selling 10,000 worth of shares and I will be buying bonds. So therefore, my shares decrease from 40,000 to 30,000 while my bonds increase from 50,000 to 60,000. And therefore everything is the same. Similarly, now when it reaches 130, my shares are now 65,000. My total portfolio becomes 1,25,000. Now see, my cushion has also increased. My cushion has increased. So therefore, what do we do? Our cushion is now 50,000. 50,000 into, so therefore we are allowed to put 1 lakh into shares. So we put 1 lakh into shares. How? By adding more 35,000. Where will this 35,000 come from? This 35,000 will come from bonds. So we sell 35,000 worth of bonds and we buy 35,000 worth of shares to reach 1 lakh of shares and 25,000 of bonds in the constant proportion insurance policy. Okay, this is your constant proportion insurance policy. And with this, we are done with the chapter and I will see you in the next one.